Evening, my name is Ariyan Johnson, and tonight I'm going to go over some of the basics of life insurance. Some of the most common things I hear when talking to clients is that there is a lack of information when it comes to buying it, so a lot of people are afraid to do so. So my goal tonight is to just give you some of the basics of life insurance so that you're not buying blind when it comes to any of it. So we're just going to keep it pretty simple for a lot of things. I'm not going to get too technical with a lot of the things, just give you some of the basic terms and give you kind of a basic understanding of what is out there for you. So to start with, what is life insurance? At its core, it is simply a contract between an insurer and a policyholder, which states that in exchange for premiums, the insurer agrees to pay a sum of money to a beneficiary upon the death of the insured. Just like with your car insurance or your home insurance, basically just saying that as long as you pay your premiums, if something were to happen, we agree to give you this money. Some contracts allow other events like a terminal or critical and sometimes even a chronic illness to trigger that payment also. But it depends on the insurance company and it depends on the type of policy that you have. But at its basics, it's just saying, hey, if you continue to pay your premiums, we will pay this sum of money if you are when you pass. There are two main types of life insurance. You have term life and you have permanent life. Term life insurance, it is temporary coverage. Most companies offer 10 to 30 years. There are insurance companies that offer a little bit more than like 50, 40 or 50 years. Just depends on your age and the insurance company. It is a little bit cheaper because it is a temporary coverage, so it is a bit more beneficial for younger people or people with children who are really just making sure they have coverage while their children are young. And it's also great for other temporary needs like mortgage protection. So if you just buy a house and something were to happen to you before you finish paying off your house, you will have that paid for through the life insurance. To ensure that your house is not lost to foreclosure if your family can't continue to pay for it. The one of the downsides to term life is that there is no cash value benefit. If you want to think about cash value as a savings account that is attached to your life insurance. Um, the other type is a permanent life insurance. And just as it is said in its name, it is lifelong coverage. So as long as you pay for your premiums, you will always have coverage. However, it does make it a little bit more expensive than term life insurance. It's also more expensive because it does have that cash value benefit. Like I said, think of it like a savings account attached to your life insurance policy. With that money, you can use it for whatever you need. Some people use it for retirement funds. Some people use it for emergency funds. You can also use it for major life purchases like buying a house, a car, or paying for college tuition or whatever else you need. One of the benefits to that is that it offers tax-free access because of the tax code. Life insurance is the IRS basically says that they're not going to tax anybody when they receive money from it, from that death benefit. And also, any gains within that cash value benefit is also exempt from taxation within reason. There are a couple different types of permanent life insurance. The first one I'll go over is a whole life policy. Whole life policy is probably the most common one that people know. It offers set premiums, meaning your premiums are the same for life. You will always pay the same exact every month or every year, depending on the type of policy you have. And it has a fixed guaranteed death benefit. So whatever you agree to when you first get your policy, that's how much your beneficiaries will receive once you pass. And that stays consistent the entire time. The cash value in the whole life also grows at a fixed rate. So if you want to understand fixed rates, think of it like adding $5 or $10 every single month into your savings account. That amount will grow, but it's not going to grow very fast. But it will grow consistently. It stays at the same pace the entire time. Another type is variable universal life. This one is a little less common, but it is still pretty much used. One of the biggest things with this is the flexible premiums and the adjustable death benefit, meaning those two can change. Your premiums can change and vary depending on how often you pay. If you pay monthly, quarterly, or annually, those can change, have the ability to change, as well as your death benefit. You have the freedom to change your death benefit over time if you want to buy more insurance. So let's say you started out with only $200,000, but you would like to change that to maybe $300,000 or $400,000 if you need more coverage, or if your life needs change, you're able to do that with this type of life insurance policy. The main component of a variable universal life is the cash value is directly invested into the stock market. So if you understand how the stock market works, it goes up and it goes down. So the money that you put into your cash value is directly invested into the stock market, meaning that if the stock market does really well, then that means you're doing really well too. However, if the stock market goes down, that means you also lose money in that. And it also affects your death benefit. And if something were to happen, if it goes completely down and you lose a lot of money, it could affect your coverage, especially if you don't have enough to pay it. So you do risk losing it if the stock market prices go completely down. Then there is Index Universal Life. This one is being a little bit more common if you've been seeing the ads all over social media. Just like the VUL, it also has flexible premiums and an adjustable death benefit. However, its cash value, it's linked to the stock market. It's not directly invested into the stock market. So you have upward growth, but you also have downside protection, meaning that you can always gain money, but you cannot lose money specifically due to the stock market. So if, say, for instance, if the stock market prices go up, stock market goes up 9%, then your values also go up 9%. However, if it goes down 20%, you do not lose that 20%. Your money stays completely the same. The caveat with this, though, there is a cap and a floor. The floor meaning you can't go any lower than 0%. And the cap can be 13%, it can be 11%, depends on the company, but you cannot go earn more than that cap. So if, say, for instance, the stock market goes up 15% and your cap is 13%, then you'll only receive that 13%. However, if you want to see a benefit to that, if everybody just lost 20% in the stock market, but then just gained another 15%, they have to play catch up and you do not. That's one of the greatest things about that. And just like with the other ones, you can also use that money for whatever you need to. Why you should get life insurance. So a lot of people feel like they don't need it. However, there are a lot of things in life that happen that we are not always prepared for. For example, if something happens to you, it's inevitable for all of us, unfortunately. Those end of life expenses are very, very pricey. Recently, I've stated in previous posts in our last webinar that funeral expenses, cremations, burials that can cost anywhere from $6,000 to $8,000, and not everybody has that on hand. So it prevents your family from coming out of pocket with those funds. I don't know if you've been seeing anybody use GoFundMe's, or anytime something happens, they're putting out Cash Apps or Venmos. So it prevents you from having to do that, to ask for donations or to raise funds for those end of life expenses. Because like I said, they're really expensive. And not only do you have to pay for funerals or burials or cremation, you also have to pay legal fees. Because if you have an estate, if it was a house, car, any financial accounts that you had, all of that has to go somewhere. And in order to have your beneficiaries get access to that, they have to go through court. And that can be very expensive and it can take a lot of time. So you want to make sure that your family has the financial ability to take care of that instead of having to try and figure out where that money is going to come from. The second thing is that cash benefit can be used for emergencies. We never know when something is going to happen, whether it's a medical emergency. Not too long ago, there was a hurricane where I am, and there were several trees that had fallen down. One of them fell on one of our friends' houses. One of them fell across the street, knocked over a power line. We were almost at risk of one falling on our car. And you never know when these things are going to happen. You want to be able to have something in your back pocket that says, No matter what, we're covered. So you have that access for that. And lastly, it creates financial legacies. Being able to provide for your family is one of the greatest things that we can do right now, especially with our economic times right now where a lot of things are uncertain and we are getting taxed left and right. Um, this provides you a sure way that once you leave here, your family is still covered, and then they can take that money and do whatever they need to. They can either invest it or they get their own policies. They can grow their own businesses. They're always going to be financially protected. They're always going to be financially safe. These are just a few reasons. There are many other reasons to get life insurance, but basically, the overall goal is make sure your family is protected if something were to happen to you. If you think about just having your car insurance or your home insurance, think about this as coverage for your family as well, making sure that they're okay. If at any point you have any questions, you can email me. I'm always available, or you can scan the QR code and meet with me. We can talk for about 10, 15 minutes or even 30 minutes to try and figure out what is best for you. Not all insurance is best for, like, not everybody is going to need a term life plan. Not everybody is going to need a VUL or an IUL. Different plans work for different people because everybody's situation is completely different, and we can talk and figure out what is best for you, what do you need, and what is going to be best beneficial for your life. So if you have any questions, like I said, feel free to contact me or feel free to scan the QR code and meet with me. Thank you guys for listening. Have a great night.